you're making at least 4 of the 7 mistakes I've seen destroy more wealth than all economic crises combined. And the worst part is that you probably don't even know you're making these mistakes right now as you read this. I spent 47 years managing money through 1987, the Asian crisis of 1997, the dot-com bubble burst of 2000, the financial crisis of 2008, and at least 3 more significant regional collapses. And in each of these crises, I saw the same pattern repeat itself with surgical precision. The same 7 mistakes appear before every collapse, made by different investors in different decades, but always with the same devastating result: the loss of assets. I'm not talking about losing 10 or 20% in a normal market correction. I'm talking about permanent wealth destruction, the kind that makes a person work 20 years to recover what they lost in 18 months. In 2008, I saw investors who had $2.3 million in September 2007 N20 with $470,000. Not because the market fell 57%, but because they made 3 of the 7 fatal mistakes at the exact moment they couldn't make them. And here's what keeps me up at night. I'm seeing the same patterns of behavior now, in 2025, that I saw in the 18 months before 2008. Complacency is at the same level. Leverage is higher. The confidence that this time is different is identical. And the 7 fatal mistakes are being made on an even greater scale than in 2007. If you're not already subscribed to this channel, subscribe now, because what I'm going to share in the next few minutes could be the difference between you being in the group that preserves heritage or the group that spends the next decade trying to recover what they lost when the next crisis comes. And it always does. The first fatal error is what I call the illusion of diversification through the multiplication of correlated assets. 93% of the investors I meet think they are diversified because they have money in 10 or 15 different funds, or because they have shares in 20 different companies in their portfolio. This is not diversification. This is a multiplication of exposure to the same systemic risk. Let me explain the brutal math of this. In October 2008, when the market was in freefall, I analyzed 342 portfolios of investors who considered themselves well diversified. The average correlation between their assets was 0.8. Do you know what that means? It means that when the market fell, 89% of their investments fell with it. No matter how many different funds or stocks they had, one guy had 23 different mutual funds. Proud of his diversification. When we looked at it, 17 of these 23 funds had more than 60% exposure to the same 50 large-cap stocks. He thought he was diversified, but he was just paying multiple management fees to have these exposures to the same concentrated risk. True diversification is not about having many assets. It's about having exposures to genuinely uncorrelated sources of return. At Bridgewater, when we built All Weather, we didn't look at 15 different assets. We looked for 15 sources of return that performed well in different economic environments. Assets that rise when inflation accelerates. Assets that rise when inflation slows. Assets that rise when growth accelerates. Assets that rise when growth slows. This is real diversification. The rest is diversification theater that collapses at the exact moment you need it to work most. In 1987, I saw this mistake destroy people who had portfolios with 30 different stocks. All 30 dropped 20% or more on Black Monday. In 2000, I saw people with 12 different technology funds, thinking they were diversified. All 12 lost 70 to 90% when the bubble burst. In 2008, I saw traditional 60-40 portfolios, which were supposed to be the gold standard of diversification, lose 37% because correlations between stocks and bonds soared to historic levels during the crisis. And I want to know from you, where are you watching this video from? Leave a comment telling me your city and country, because this mistake of false diversification is global. And I want to understand how many people in different parts of the world are falling into this trap right now as the signs of a new crisis accumulate. The second fatal error is what I call optimizing for the last economic environment rather than preparing for the next. People adjust their portfolios based on what has worked in the last 3 to 5 years, not what will work in the next 3 to 5 years. This seems obvious when I say it like this, but it's exactly what most people do without realizing it. From 2009 to 2021, what worked? Growth at any price. Technology stocks, disruption, companies without profits, but with sexy narratives. And what did everyone do? Optimize your portfolios for more exposure to exactly these assets. In 2021, 41% of American individual investors had more than 60% of their portfolios in growth assets, not because they believed that the environment in the coming years would be the same as in recent years, but because they saw these assets go up 80, 120, 200%, and they thought that this was the new permanent reality. This violates a fundamental principle I learned the most painful way possible. Never assume that the environment that has produced your best returns in recent years is the environment that will continue. Environments change, and when they change, assets that were kings in the previous environment become the biggest losers in the next. In 1982, what worked for a decade was inflation hedges. Gold rose from $35 an ounce in 1971 to $850 in 1980. Commodities exploded. Real estate soared. Everyone who was sophisticated had portfolios heavy on inflation protection. Then Paul Volcker broke inflation. And from 1982 to 1999, those who were optimized for high inflation lost 17 years of performance, while bonds and stocks led. In 1999, what had worked for 17 years, growth stocks, internet, new economy. Whoever was optimized for this lost 70% of 2002. In 2006, what had worked, real estate and leverage. Whoever was optimized for this was destroyed in 2008. Do you see the pattern? People optimize for the environment that is ending and are massacred when the new environment arrives. Now, in 2025, which environment is ending? 12 years of zero interest rates, endless money from the Fed, valuations that ignore profits because growth was all that mattered. And what environment should you be preparing for? An environment where interest rates are structurally higher, where the Fed cannot print money infinitely without consequences of inflation, where profits and cash flow once again matter more than narratives. But what are the majority doing? Still optimized for the environment of 2012 to 2021. And when the environment changes, they'll be caught completely exposed. The third fatal error is confusing low volatility with low risk. This is deadly because it creates a false sense of security that leads people to take more risk exactly when they should be taking less. From 2017 to the beginning of 2020, the VIX, which measures expected volatility, spent 18 months below 12 points. Investors interpreted this as a sign that risk had decreased. The market was calm, so it should be safe to increase exposure. They sold protection through puts because they thought it was free money. They increased leverage because with such low volatility, margin calls seemed impossible. They reduced hedging because the cost of protection seemed wasteful when nothing was happening. And then came February of 2020. VIX went from 12 to 82 in 3 weeks. The market fell 34% in 23 days. And all those who confused low volatility with low risk were obliterated. At Bridgewater, one of my core principles is that times of greatest risk are preceded by periods of lowest apparent volatility. Why? Because low volatility breeds complacency, and complacency breeds behaviors that increase invisible systemic risk. People increase leverage when they should be decreasing it. They concentrate positions when they should be diversifying. They sell protection when they should be buying. All this activity increases the real risk of the system, while measured volatility remains low. It's like a dam building up pressure behind a wall that seems perfectly calm until the second before it breaks. In 1987, the 6 months before Black Monday had an average volatility of 9.3, the lowest in 5 years. Everyone thought that the market had entered a new regime of permanent stability. Then on October 19th, the market fell 22.6% in one day. In 2007, the 12 months before the crisis, had VIX average of 12.4. Everyone was selling protection, increasing leverage, assuming that the Great Moderation had eliminated tail risk. Then Lehman went bankrupt, and the entire system almost collapsed. Do you know what the average VIX is now in 2025? 13.8 in the last 6 months. Do you know how many times in history, when VIX was below 15 for more than 6 months, it was not followed by a spike above 30 for the next 18 months? 0 times. 0 Each period of prolonged complacency was followed by a burst of realized volatility, and yet most investors are interpreting the current calm as confirmation that there is no danger, making exactly the same mistake that was fatal in 1987, 207, and every other pre-crisis. The fourth fatal error is what I call anchoring to recent prices rather than fundamental values. People use the price an asset had last year as a reference to decide whether it is expensive or cheap today, completely ignoring whether that price made sense in relation to the fundamentals. This creates a dangerous spiral where assets become more expensive, establish a new anchor point, and then become even more expensive because the new level appears normal. Let me give you a concrete example of the kind I've seen destroy billions. In 1999, I analyzed conversations with investors buying Yahoo at $120 a share. I asked why they were buying it. The typical answer was because it was cheap compared to the $180 it had achieved 2 months earlier. Nobody talked about the fact that Yahoo was worth $15 billion, but had only $60 million in profits, a price-earnings multiple of 250 times. No one questioned whether even at $120 it was fundamentally overvalued. The anchor point was $180, so 120 seemed like a bargain. Yahoo fell to $4 over the next 2 years. Whoever bought at 120 lost 97%. In 2006, I saw the same thing with real estate. Homes in Las Vegas suburbs that sold for $180,000 in 2003 were for $450,000 in 2006. People bought it because it seemed cheap compared to the $520,000 that the neighbor had ordered the month before. No one asked whether a house that cost $210,000 to build should be worth $450,000. No one calculated that the monthly mortgage payment took up 52% of the region's average family income. The anchor point was $520,000, so $450 seemed reasonable. These houses fell to $110,000 in 2011. Those who bought in 2006 lost 76%, and many never recovered because they had to sell in foreclosure. Now in 2025, I'm seeing the same pattern. Artificial intelligence stocks trading at 80 times earnings. Not profit, revenue, but investors say it's cheap because it was at 110 times revenue 6 months ago. Properties in Austin and Miami that have doubled in price since 2020. But buyers say it's reasonable because it was 15% more expensive at its peak in 2022. Cryptocurrencies that rise from $20,000 to $60,000. And everyone says it is at a discount because it was once at $69,000. The anchor point is always the recent peak, never intrinsic value or fundamentals. And this is fatal because it means you are always buying at the top of a bubble using the previous top as justification that it is not that expensive. At Bridgewater, we developed a framework that we call valuation in a 40-year historical context. We don't look at whether an asset is cheaper than it was last month. We look at where it is in relation to the average and standard deviation of valuations over the last 40 years, when S&P price-earnings multiples are 2 standard deviations above the long-term average. It doesn't matter if they were 3 standard deviations 6 months ago. It's expensive. Point. And you should be reducing exposure, not increasing it, because it's 15% cheaper than the recent insane spike. The fifth fatal mistake is waiting for certainty and confirmation. Before acting instead of working with probabilities and protection, people want to wait until they are absolutely sure that a crisis is coming and then position themselves defensively. But when you are sure that the crisis is coming, it is too late to protect yourself at a reasonable cost. All protection has already been priced on the market. It's like waiting to see black smoke coming out of your engine before buying car insurance. Too late. Insurance will now cost more than the car is worth. In August 2007, I had conversations with 3 different fund managers, ENTs, who wanted to wait for more data before protecting themselves against a crisis in the real estate market. They saw the signs. Subprime was clearly failing. Bear Stearns had liquidated to hedge funds in July, but they wanted certainty before spending money on protection. They wanted to see credit spreads explode, banks fail, contagion evident, and then they would act. 2 of the 3 waited until October to start buying protection. At this point, the cost of puts had tripled. The 3rd waited until January 2088. Hot tat point, the CDS spread on mortgage-backed securities had gone from 50 basis points to 800 basis points. Protection existed, but it costs 15 times more than in June 2007. All three lost between 32 and 48% on their funds in 2008 because they acted late. Compare that to what we did at Bridgewater. In February 2007, when the first signs of subprime stress appeared, we didn't expect certainty. We calculated that the probability of a systemic crisis in the next 18 months was 45%. Not sure. Less than 50%. But a 45% probability of losing 50% justified. Spending 2.3% of the portfolio on protection. We buy puts in financial institutions. We buy CDs on mortgage bonds. We buy long-term treasuries. It costs 2.3% of the equity. When the crisis hit, these positions returned 142%, more than offsetting any losses in the rest of the portfolio. We ended 2008 with a gain of 8.7%, while the market lost 37%. Not because we were sure, but because we understand that in finance you work with probabilities and protection, not certainty and confirmation. If you wait for certainty, you will never protect yourself in time. The time to buy protection is when it seems like a waste because nothing is happening. The moment you are sure you need protection is the moment you can no longer buy it at a price that makes sense. Now, in 2025, I see the same signs that I saw in 2007. I'm not sure we'll have a crisis in the next 12 months, but I put the probability at 40 to 50%, and a 50% chance of losing 40% justifies spending 3% on protection now. But most are waiting for certainty, and when they are sure, they will discover that protection costs 10 times more, and it is already too late. The sixth fatal error is what I call normalcy bias applied to system stability. People assume that because the financial system has survived the last 5 crises, it will automatically survive the next one. This creates dangerous complacency about tail risk and systemic risk. The logic is always the same. Governments and central banks have always intervened before, so they will always intervene again. The system has always recovered before, so it will always recover again. This ignores 3 fundamental truths about complex systems. First truth: every intervention that saves the system from one crisis makes the system more fragile for the next crisis, because it encourages more leverage and more moral hazard. Second truth: each crisis consumes monetary and fiscal policy ammunition, leaving fewer tools available for the next one. Third truth: complex systems don't break linearly. They break in an avalanche where decades of accumulated stress collapse all at once. Let me show you this in practice. In 1987, the Fed cut rates from 7% to 6.5% in 3 weeks and stabilized the market. He proved that he could intervene and work. This encouraged more leverage in the 90s because everyone knew the Fed was there as a backstop. In 1998, when long-term capital management nearly broke the system, the Fed coordinated a $3.6 billion bailout and cut rates. Again, intervention worked. Again, this encouraged more leverage and more complacency. In 2001, when the dot-com bubble burst, the Fed cut rates from 6.5% to 1% in 30 months. It worked. Saved the system. But it encouraged the biggest real estate bubble in history. In 2008, when this bubble burst, the Fed had to go to zero and invent 3 rounds of quantitative easing, totaling $4.5 trillion to save the system. It worked, but at the cost of creating American public debt that went from $10 trillion to $28 trillion. In 2020, when the pandemic hit, the Fed had to inject $5 trillion in 16 months, and the government spent another $3 trillion. It worked, but it created 9% inflation and $34 trillion federal debt. Do you see the pattern? WH Rescue worked but required greater intervention and created greater problems. And now, in 2025, if the next crisis comes, what will the Fed do? We already have a federal debt of $34 trillion, 123% of GDP. We have already used quantitative easing 4 times. Rates are at 5.25%, giving some ammunition, but not the 12% margin we had before 2008. And most importantly, political and social tolerance for bailouts is at its lowest level in decades. Do you really think that if 5 major banks fail simultaneously, that Congress will approve $3 trillion in bailouts without massive resistance? Do you think if the market drops 50%, the Fed can print $8 trillion without creating 20% inflation that would destroy the middle class? The normalcy bias error is to assume that because the last 6 interventions worked, the 7th will work too. But systems don't work like that. They accumulate fragility to the point where they no longer have the capacity to absorb the next shock. And all the evidence suggests we're at that point now. The 7th fatal mistake, and perhaps the most devastating, is optimizing your portfolio for maximizing return rather than maximizing survival through full cycles. People build portfolios trying to capture every percentage point of upside possible, without considering that a single minus 50% tail event can wipe out decades of compounding gains. This violates a fundamental mathematical principle I learned in my early years at Bridgewater. Compound returns are a function of avoiding big drawdowns, not capturing every rallies. Let me show you the brutal math of this. Imagine 2 investors over 30 years. Investor A has an aggressive strategy that captures 95% of all rallies, but suffers drawdowns of 40 to 50% in crises. Investor B has a balanced strategy that captures only 70% of rallies, but limits drawdowns to 25%. Intuitively, you might think that Investor A will end up with more money because they are capturing more upside. But the math proves the opposite. If the market rises 15% per year on average, Investor A captures 14.25% in good years. Investor B captures 10.5%. It looks like A is winning, but when the crisis comes at minus 48%, Investor A loses 48%, while Investor B loses 24%, and here's the math that kills. After losing 48%, you need a 92% return just to get back to where you were before. After losing 24%, you only need a 32% return. Over 30 years with 3 major crises, Investor A ends up with final capital of $8.2 million. Starting from $100,000, Investor B ends up with $12.7 million. Capturing less upside but surviving drawdowns produced 55% more wealth. This is not theory. I've seen this happen hundreds of times in 5 decades. In 1999, I met an investor who had turned $200,000 into $3.8 million between 1995 and 1999 by investing heavily in technology stocks, average annual return of 72%. He was euphoric, feeling like a genius. I thought I had discovered the formula. He continued with the same aggressive strategy. In 2002, his $3.8 million had become $520,000, loss of 86%. To recover the $3.8 million from $520,000, he would need to return 630%. It never recovered. Today, in 2025, 25 years later, he is $1.2 million, less than a third of what it was at the peak. Compare this to another investor I started following around the same time. He had $150,000 in 19 used balanced all-weather strategy. Average return of 9.3% per year, much less exciting than 72%, but it never suffered a drawdown greater than 21%. In 2002, while the first one had lost 86%, this one had only lost 18%. He continued composing. Today he has $3.7 million, almost 3 times more than the aggressive investor who had years of spectacular performance but did not survive the crisis. The lesson is pure mathematics. Long-term compounding is broken by large losses. A 50% loss requires a 100% gain to recover. A loss the 70% one requires 233% gain to recover. Most never recover. That's why at Bridgewater our obsession has never been to capture maximum upside. Our obsession has always been to limit maximum downside while capturing sufficient upside. This seems conservative, but mathematically it is the only way to truly build wealth through decades and multiple crises. Now, I know exactly what's going through your head right now. You are thinking one or more of these 3 things. First objection. Okay, I understand that these mistakes are dangerous, but how do I know that the crisis will come now? Maybe it will take another 5 years, and I will lose all those gains by getting defensive too soon. This is the perfect timing trap, and I'm going to show you why it's fatal. In 2005, some smart investors started to get defensive about the housing bubble. They were right about the diagnosis, but apparently wrong about the timing. The market continued to rise for another 2 years. Some people ridiculed these investors for being early and missing out on the gains of 2006 and 2007. But here's what happened. Those who were defensive in 2005 lost perhaps 15 to 20% upside over the next 2 years. Those who waited to be sure and were exposed lost 40 to 50% in 2008. Being early cost 15% of lost earnings. Being late costs 45% of real losses. Which is worse, losing gains you never had or losing capital you had? The answer is obvious, but people hate losing potential gains more than they fear losing real capital. This is psychological bias, not rational logic. At Bridgewater, I'd rather be 2 years early than 2 months late, always. Because the cost of being early is not capturing any upside. The cost of being late is permanent destruction of capital. They are not equivalent. Second objection. I know you're thinking, but I don't have the sophistication or resources of Bridgewater to implement these strategies. This is partially true, but uses it as an excuse for inaction. You don't need to replicate all weather with 20 asset classes and tactical leverage. You can implement the principles in a simplified version, balancing risk between shares, bonds, gold, commodities, and cash. Systematic protection via puts on 5 to 10% of the portfolio. These are things that any individual investor can do. The mistake is to use the complexity of the institutional version as an excuse for doing nothing. Doing the simplified version is infinitely better than doing nothing. Third objection. I see all the time. But if I protect myself and the crisis doesn't come, I will have wasted money on expensive protection that expires worthless. This reveals a fundamental misunderstanding of what protection is. Protection is not a bet you want to pay. Protection is insurance that you hope will expire worthless because it means nothing bad happened. Do you complain that your home insurance was a waste because your house didn't burn down? No. You are happy that you paid the premium and your house is intact. The same applies to portfolio protection. If you spend 3% a year on puts and the crisis doesn't come, you didn't waste 3%. You paid 3% to sleep peacefully, knowing that if the crisis comes, you won't lose 40%. It is the prize of tranquility and survival. And mathematically, over decades, this premium more than pays for itself because it saves you in the years when the crisis really hits. The choice you have now is binary, and you need to make it consciously. Option 1. You take in what I've shared here. Recognize that you're making at least some of these 7 fatal mistakes, and make changes to your portfolio in the coming weeks to position yourself defensively. You reduce exposure to overvalued assets. You add true diversification through uncorrelated assets. You buy some protection while it's still cheap. You clear leverage. You prepare for the next cycle instead of optimizing for the last one. You do this now while the VIX is at 13 and complacency is high and no one is hedging. You seem paranoid for 6 to 18 months. Your friends may make more money than you in the short term, but when the crisis comes, you preserve 90% of your assets while they lose 40 to 50%. And over the next 20 years, you make up from an intact base as they try to regain what they lost. This is option 1. Option 2. You hear all this, agree intellectually that it makes sense, but do nothing because it seems extreme, because your friends aren't doing it, because CNBC isn't warning about an imminent crisis, because your advisor says market timing doesn't work. You continue doing what he was doing, 60% in high valuation growth stocks, 20% in bonds that will fall if inflation returns, 10% in crypto that has 0.8 correlation with stocks, 10% in cash yields 3% while inflation is at 4%. Zero protection because it seems like a waste. And then over the next 6 to 24 months, when the signs of crises intensify and finally become obvious to everyone, you'll want to protect yourself, but you'll find that puts that cost 2% now cost 15%. You will ultimately want to be defensive, but everyone will want to be defensive at the same time, and there will be no bid for your overvalued assets. And you'll watch your portfolio drop 30 to 50% while remembering that you heard that warning but didn't act. This is option 2. There is no option 3 where you expect more data, more confirmation, perfect timing. This fantasy of perfect timing is just another way of choosing option 2. You choose to act imperfectly, or you choose not to act and accept the consequences. And if this content alerted you to risks that you weren't seeing, leave a like now, because this helps the algorithm take this message to more people who need to protect themselves before it's too late. And if you're not already subscribed, sign up and activate the bell, because in the next videos, I will break down each of these protection strategies into practical and actionable details that could make the difference between preserving or losing decades of wealth accumulation when the next crisis comes. I spent 47 years watching the same patterns repeat themselves in different decades with different actors, but always with the same brutal mathematics, and always with the same 7 fatal mistakes being made before each collapse. I saw Black Monday in 1987, where I lost 4% for not having hedged enough, a lesson that was costly but saved me billions in subsequent crises. I saw the savings and loans crisis, where 747 institutions went bankrupt because they assumed interest rates would never rise. I saw the dot-com bubble destroy $14 trillion because investors optimized for infinite growth while ignoring profits. I saw 2008, where Lehman, Bear Stearns, Merrill Lynch, all giants that seemed invincible, collapse because they made exactly the same 7 mistakes that I described here. I saw the European debt crisis of 2011. I saw the correction of 2015. I saw the crash of 2020. In each of these crises, I had investors calling me in a panic after the collapse had begun, asking what to do, and the answer was always the same. It's too late to protect yourself now. You should have done it when it seemed like you didn't need to. Economic cycles are machines that work in predictable mathematical patterns. It's not about predicting the exact day of the crash. It's about understanding what phase of the cycle we are in, what behaviors this phase encourages, and what errors these behaviors produce. Now we are in the late phase of a long expansion, with high debt, high valuations, high complacency, and all 7 fatal mistakes being made at scale. History shows that this combination always, and I mean always, ends in severe correction. I don't know if it will be in 6 months or 18 months, but I know it will be. And I know that anyone who protects themselves now will regret it for weeks when nothing happens immediately. But anyone who doesn't protect themselves will regret it for decades when the heritage that took 20 years to build disappears in 18 months. Choose your weeks of regret now or your decades of regret later.